Thibault Dorlet, gestor senior de carteras multiactivo en Candriam. Hi Thibault, good morning, good afternoon.
Hello everyone.
Well, how do you anticipate that the U.S. employment data will influence asset allocation decisions in multi-asset portfolios, particularly in terms of equity and fixed income positioning?
So, well, we just got the answer. February payroll came at minus 90K, so which is a deeply negative surprise against the consensus, which was at plus 130K. So that's a significant number, and it lands at the worst possible moment for the Fed, I believe. And it creates a dilemma. The Fed is now facing a labor market that is visibly slowing, while simultaneously dealing with an energy-driven inflation shock. Top PC was already at 3% before the oil spike, and market had been pricing only 40 basis point cut by year-end. So the math has just changed dramatically over a couple of minutes. The Fed cannot ease aggressively without risking fueling inflation further, and it cannot stay on hold without ignoring a significant deteriorating labor market. So that's the stagflationary trap we've been stress testing, and today's numbers suggest it's no longer a tail risk. In terms of asset allocation, it reinforces our neutral stance on US Treasuries. That's because duration isn't attractive. We have positive carry and so on, but in an eventual slowdown, would be difficult. But because the inflation overhang from energy prices limits how far the Fed can go, it will be difficult for the Fed. And the more interesting question now is whether this accelerates a rotation away from US assets more broadly, which would support our existing positioning on European credit, gold, and community-linked currencies. But the impact on equities at this stage is difficult to assess because we don't know exactly what's going to do the Fed.
And to what extent is the ongoing US-Iran geopolitical tension impacting risk premiums, hitting strategies and liquidity management within multi-asset portfolios?
So markets had partially anticipated this, right? Risk premia were already rising pre-strikes, with oil up more than 20% year to date, gold climbing, and defensive outperforming cyclicals. But equity indices, particularly outside the US, were still near highs going in, meaning the full geopolitical premium was not yet embedded. What's particularly telling now is that 12 months Brent futures are also moving higher, and this is not just a spot market reaction. Markets are now increasingly pricing a prolonged conflict, and the key variable remains the Strait of Hormuz, roughly 20% of world oil and energy, which is blocked. In our base case, at $75 a barrel, the impact is manageable. But the move above $100, and usually goes directly from 90 to 110, 120, the maths are different. Roughly 1 full percentage point added to US inflation would lead to US GDP growth closer to 1% by end 2026, with Brent around $100. And Europe GDP should be pushed below 1%. So there was some partial relief overnight. The US exploring market intervention in the Strait of Hormuz, a waiver on Indian purchase are rational, but these are short-term measures, not structural solution. On hedging, which was your question, we've added portfolio protection via derivatives. We kept gold as a core conviction hedge, reduced our dollar underweight, given safe haven dynamics, and maintained dry powder for agility. We also trimmed our equity overweight in emerging markets, especially, which are the most impacted by a stronger dollar and higher crude oil, as they are importers. Also, if the scale and duration of the conflict increase, we will further reduce our allocation to this.
Given current macroeconomic and market conditions, which sectors or asset classes are presenting most compelling risk-adjusted investment opportunities over the next quarter?
So the conflict has sharpened some conviction and created important distinction within asset classes. Energy, mining, defense are natural hedges here. Within emerging, the oil shock creates a clear divide. Exporters like Brazil benefit, while heavy importers like India, China, but also Korea face inflation pressures and tighter financial conditions. We have reduced exposure to Asian tech, particularly Korea and Taiwan, where valuation has run well ahead of fundamentals. The KOSPI is heading for a weekly decline exceeding more than minus 10% as I speak, and that validates our more cautious stance here. Within tech, more broadly, we remain selectively constructive. The indiscriminate software setup that we've been facing has created entry points, and recent market sessions have confirmed that resilience in risk update. European industrials and German and US small cap remain a conviction also, anchored by fiscal expansion. On fixed income, European investment grade is our preferred positioning. On emerging debt, we are still overweight on absolute yield, but more defensive, as spread haven't fully priced the geopolitical risk that we're facing yet. And gold works across multiple scenarios. It is a geopolitical hedge, real rate volatility buffer, and central bank buying is a natural support. And now a weakening growth outlook in the US with the labor data makes a rare confluence for supportive factor for gold.
How are expectations regarding central banks' policy risks, including interest rates and balance sheet adjustment, being integrated into your multi-asset allocation framework?
Yeah. Well, we're dealing with three central banks in three different situations, and that divergence is itself a key input to our allocation. So start first with the Fed. Today, minus 90K payroll prints, put it in a difficult position. The textbook response to a collapsing labor market is to ease aggressively. But here, with core PC already at 3% and oil above now 590, that path is largely closed. The Fed here is trapped between the two legs of its dual mandate, pulling in opposite direction. And frankly, market pricing only 40 basis points of cut by year-end may still be too optimistic about ability to deliver. The second central bank is the ECB. On its side, is facing a different version of the same problem. The repricing over the past 48 hours has been dramatic. Market went from pricing a 55% probability of a cut last Friday, and today we're at 100% probability of a hike by December. Bund yield posted their biggest single-day jump in a year just yesterday, and the ECB is visibly divided, with the Guindos acknowledging a policy change that could be warranted, while Villeroy de Gallo is pushing back. And that internal tension adds another layer of uncertainty. And it's why we've trimmed our European duration position as the risk-reward has narrowed materially. Now, the Bank of Japan is the outlier, still in tightening mode, and that actually reinforces our Japanese equity overweight. Reform momentum and fiscal stimulus are driving that call, not monetary accommodation.
Finally, Thibault, what is your assessment of potential trade policy shocks, such as US tariffs on European goods, and how do they influence your scenario analysis and portfolio stress testing?
Well, trade policy risk hasn't disappeared. It's been overshadowed by the geopolitical shock, but it remains embedded in our stress testing. The scenario we're most focused has just become more plausible. Sustain high energy prices and a weakening of the US labor market, and also tariff escalation simultaneously. A triple shock that would leave central bank with no good options. Given where core PC already stands, that scenario is less practical than it might have seemed just 3 months ago. Also, European equities have shown notable resilience to tariff headlines, supported by German fiscal expansion actively deployed, which is why we maintain today our slight Europe overweight on domestically driven industrials and mid-cap. More broadly, our portfolio is now built for a multi-shock environment, and in that word, capital preservation tools like derivatives, gold, commodity-linked FX become as important as return generation.
Thibault Dorlet, gestor senior de carteras multiactivo en Candriam. Thank you for coming to Negocios TV.
Thank you so much. It was great fun.